When my wife and I found out we were having twins, my '08 Chrysler Sebring, wasn't gonna cut it. I knew it was time to buy a new car, but my main concern was, babe, could we even afford one? 85% of Americans are in the same boat. Most of us buy cars without having all the money in our pockets up front. So instead, we lease or finance. But how did this happen? Like, when did borrowing money to obtain a car become the American way? And what the heck is leasing anyway? Most importantly, was it the right choice for me? Let's get into it. Jerry's got your back. It all started in 1908. That's when Henry Ford's Model T hit the market and revolutionized the automotive industry. A reliable and more affordable American-made car for American consumers. For a small luxury price of $850, you could be the talk of the town. By the way, that's like $28,000 today. But Henry Ford had a dream. Make the Model T so accessible that even his workers could afford one. With this new strategy, Ford's Model T overtook the car market. However, some of the emerging middle class still found it hard to scrape together the cash up front for Ford's affordable car. Even with Ford's ability to mass produce the car and lower its costs, people still couldn't afford it. Then something revolutionary happened. General Motors started offering car loans to consumers in 1919. You see, President Alfred P. Sloan and a few of his executives came up with the idea of giving people the ability to buy things they couldn't afford with the money they had in their pockets. So, they created General Motors Accepting Corporation, a financial service entity for General Motors to loan consumers the extra money they needed to purchase cars. With 35% down and the rest due over a course of a year, the car was yours. They called this selling cars on time. Henry Ford was heated, and he hated the new fangled idea. So, he offered his customers a weekly layaway plan. Customers could pay $5 or $10 a week until they built up enough equity to finally get the car they ordered. But that meant waiting. Consumers wanted to live large now, not later. And so, automotive financing was born. Let's fast forward to 1939. When Zollie Frank and Armund Schoen came up with the brilliant idea of renting out cars to businesses on a monthly basis, without the need to make huge investments up front. And when that lease was over, Frank and Schoen would just sell the cars. Any profit was returned to the client, but if the resale value wasn't enough to cover the total cost of the car, they billed the difference. This was wildly successful, and it was so successful that it was soon adopted at the consumer level. So, how does this all work today? Let's take a look at the Toyota RAV4 that costs around $30,000 with a 3-year lease payment plan. The dealership will estimate how much the car's value will decline during that period, say $20,000. So your monthly lease payment would cover that $10,000 loss in value, plus some added finance charges over the course of 36 months. That sounds great. I can have a car that I don't have to pay in full and they maintain it. So win-win, right? Well, it's those added finance charges that get you. The average APR, or annual percentage rate, for a lease vehicle is anywhere between 6 to 14%.
That hurts. That really hurts.
When you finance the same RAV4, it's a loan on the money, not the car. Right now, the average APR loan is anywhere between 3 to 6%. So comparing that to a lease, you could be paying double the amount in a shorter amount of time. Another consideration is the vehicle's depreciation. You know the saying, it loses half its value once it leaves the lot? Yeah, it's an exaggeration, but not far off. Typically, a car loses 60 to 70% of its value within the first 5 years. This means when you return a leased car, the condition it's in is really important because it will be resold at a market value. So, in order to make profit, companies put a lot of restrictions on you while you have the car. Lease agreements typically come with mileage limits, so no cross-country road trips for you. Excessive wear and tear charges can cost you even more when you bring the car back from term. Leasing agreements typically prohibit you from customizing your vehicle, so no presidential tint, 22-inch trims, you get it. And last but not least,
I see what you did there.
If your lifestyle changes in the middle of term and you want to get out, you may be stuck with an early exit termination fee. And that's why my family decided to finance the brand new 2023 Honda Palisade. As a dad of two, it was important for us to have something we could travel long distance with, have no wear and tear restrictions because, kids are kids. And also, if we wanted to upgrade to something larger, well, the equity in the car would be ours when we wanted to sell it. If you don't want the responsibility that comes with owning a car, you may want to spend that extra cash to lease. Or if you like the idea of changing out your vehicle every 3 years to keep up with the Joneses, well, leasing may be for you. In the end, your decision should align with your individual preferences and circumstances. It may be how many Cheerios you think will end up in the back seat.
Jerry, the All Car app that's got your back. Because we car.